One of the main reasons why people wanted to get into Airbnb is for the tax benefits, specifically the cost segregation strategy that lets you front load massive deductions in year one. But let me be really clear, you should never invest in something just for the tax strategy. The tax benefits should be the cherry on top, not the sole reason why you invest. With that being said, the difference between buying a $200,000 property versus an $800,000 property can completely change your tax outcome. And if you don't understand how purchase price works, land value, and the IRS rules, you might drop six figures in cash to only get $30,000 back. So in this video, I'm breaking down how to maximize your tax savings on your first Airbnb and how to avoid a costly mistake before you go and put the down payment on that property. I'm Anna. I'm a licensed CPA and tax strategist, and my team works with short-term rental investors every single year. We've had clients get back to up to $200,000 in tax refunds. But we've also seen people put down in a down payment over six figures to only get back $30,000 in tax benefits. It all comes down on how to structure your deal, what state you invest in, how the land is valued, and whether you not even meet the short-term rental loophole. So let me walk you through how this works step by step with real-life examples of my clients. Let's start with why is this strategy so powerful for high net income earners? How do you qualify for that? There are two major requirements to qualify for the short-term rental loophole. Number one is the stay test. You must have at least 2 stays with an average stay of 7 days or less. You're turning people in and out like a hotel. So let's say, for example, you buy the property in December and you only have 1 stay. You're done. Why? Because in order to have an average, you have to have 2 stays. So you have to make sure you have on average 7 days or less stay. So you need a minimum of 2 stays. Requirement number 2 is material participation. You need to prove that you are involved in the day-to-day operations of this Airbnb. Now, the IRS gives you 7 different ways you can prove this, but here are the 2 most common ones that my clients use. 1, you must spend at least 100 hours or more than anybody else working on the property. Or you can spend at least 500 hours total during the year on that property alone. You can't just have a property manager sit back and collect your money. Why? Because that would be passive income. And yes, you need to have immaculate time logs because in case of an audit, because we've been through and we've successfully defended them, the IRS will ask for that time log. Let's go over a real life example of one of our clients and how this actually works. So one of our clients was a high net income earners. They went out and they bought a short-term rental. They did a cost segregation study and we were able to save them over $100,000 in taxes, you guys. That is one of many clients that we do this every single year. But what was the difference? Before they went and purchased that property, we ran the numbers. We did an estimate on the cost segregation and we ran a projection. So we made sure that having them purchase this property was actually going to yield them a return on their investment for this property. And most importantly, we made sure that they actually qualified for the short-term rental loophole by qualifying both of those tests. The property was perfect, it's running, and it's generating income. Everything was perfect. But unfortunately, that's not every case. So now let me give you a case study where it went completely wrong. We had a doctor in California who wanted to buy a $1.2 million property to use as a short-term rental. And I'm not going to lie to you guys, they were looking at it primarily for the tax benefits. So before they went and did that, we ran the same full analysis that we did for the other guy. The problem here was that the land was valued at $700,000. That meant that there was only $500,000 left of that $1.2 million available for depreciation. So after we ran the numbers, did the cost segregation factor in for bonus depreciation and their material participation rules, we realized that it was only going to yield them about a $30,000 tax savings. And you might think that's a lot, right? But guess what? They were about to put $400,000 into it of their own cash between the down payment and the improvements. That return on investment was just not there. Had they not come to us and done a tax planning, they would have wasted $400,000 to realize the ROI was not there with this short-term rental. So they ended up investing in a different state where land values were a lot lower and the depreciation could do a lot more for them. Let me give you some free tax advice. If you are considering this tax strategy, number one, track your time log. Log every hour that you spend in your short-term rental. If you get audited and do not have the proof, the IRS can reverse that deduction. There's a video that I recorded that I talk about the most red flags that the IRS looks for, and this is one of them. Now, it's not just my word. It came from the IRS agent that just audited one of our clients specifically for the short-term rental. So go watch this video if you want to know what they're looking for in case of a short-term rental audit. Another tax tip: get a cost segregation done by a qualified engineer. Do not try to do this on your own or those DIY calculators. You want to make sure that they are audit proof. And in case of an audit, you just call someone and they help you out. The most important tip, you guys, is run the numbers before you go put a down payment. Just because a property is expensive, as you saw in the case above, does not mean that it's better for tax savings. High land value in states like California, Colorado, can kill your depreciation. Now, work with a CPA who understands the short-term rental strategy because not every tax pro actually knows this loophole. Not working with a right tax strategist can literally kill your wealth. Let me give you a real-life example of Mitch and Katie, who had a CPA who did not know anything about the short-term rental loophole. We amended their tax return, cut their bill by $100,000. This $100,000 keeps coming back again, but it's true. They are now closing on their second boutique hotel at $3 million. Had they stayed with the same CPA, one can't argue that they may have not been not paying any taxes at this point. Make sure that your CPA is actually signing off on your return for the strategies that they give you. Please note that you are still responsible for what is shown on your tax return. When you put your John Hancock on that return, you are stating that you not only understand, but that you agree with what's on your tax return. So in case of an audit, if you try to play dumb and say, well, that's why I hired a tax strategist, the IRS can come back and say, sorry, you signed this return. It is your responsibility. The short-term rental tax strategy is extremely powerful, but it has to be done right. And this is one of the biggest red flags the IRS is watching for in 2025. We have successfully defended clients in these audits. And like I said, they were triggered by cost segregation studies, but only because they had the right documentation, the right strategy in place, and the right CPA behind them. If you want help running the numbers before you buy or making sure that you qualify for the short-term rental loophole, make sure to book a call with one of our team members on our website below. If you found this helpful, like and subscribe, you guys. I post weekly tax strategies for business owners, real estate investors, and high net income earners every single week. Make sure to follow us on social media. And remember, this is not tax advice. It is just for educational purposes only.